All right, get ready to dive into the stock market. We've got some fascinating articles and lessons lined up for you guys today.
Yeah, we're going to help you grasp the basics of how the market works, before you even think about investing.
And let me tell you, it's pretty surprising how many people out there own stocks, but don't really have a clue about the ins and outs.
It's true.
But after this deep dive, you definitely won't be one of them.
You'll be able to drop some serious stock market knowledge.
That's right. So first things first, what is the stock market?
It's a term we hear all the time.
Right, thrown around constantly.
Yeah.
But what does it actually mean?
Well, imagine a massive online auction, but instead of bidding on like vintage records or, that antique lamp you've been eyeing.
Oh, I love those.
Yeah, right? Instead, you're buying and selling pieces of companies,
Okay. And these pieces are called what?
stocks.
Stocks. So instead of going to a physical auction house, this is all happening online.
Exactly. And these online auction houses are known as stock exchanges.
Stock exchanges, got
Yeah.
it.
And get this, there are over 60 major stock exchanges worldwide,
Wow, 60.
each with their own set of rules and their own trading hours.
Okay, so how do they determine which exchange is the biggest?
Well, the biggest one, based on market capitalization, the total value of all the companies listed,
Right.
that would be the New York Stock Exchange.
The NYSE. I've heard of that one.
The one and only. So all the buying and selling of these stocks, it all goes down through these online exchanges.
It's a far cry from those crazy trading floor scenes we always see in the movies, right?
Yeah, for sure. Though some physical trading floors are still around.
Oh, really?
But nowadays, most transactions happen electronically,
Makes sense.
through online platforms like Questrade.
Much more efficient.
Absolutely. So we've got these online platforms where stocks are traded.
Right, but how do they figure out the prices for these stocks? Is there some, secret formula they're using?
Well, the formula is actually pretty simple, supply and demand.
Oh, okay, so Economics 101.
Exactly. Think of it like trying to score tickets to a Taylor Swift concert.
Ooh, yeah, good luck with that.
High demand, limited supply, the price goes through the roof.
Right, it's like basic economics, the scarcity thing. So if everyone's excited about a company and wants to buy its stock, the price goes up.
You got it. Buyers put in their bids, sellers set their asking prices.
Like an auction.
Exactly. And when those two match, bam, a trade happens.
Right.
And that sets the current price.
Okay.
And get this is happening constantly
Okay.
throughout the entire trading day, which is why you see those stock prices going up and down all the time.
So it's this back and forth between buyers and sellers pushing the price around all day.
Just like a dance, a
Yeah.
stock market dance off. I like it.
Millions of orders flying back and forth every single second.
Whoa.
And just like an auctioneer keeps things moving, there are these market specialists. They make sure trading keeps flowing,
Okay.
even when there isn't an immediate match between a buyer and a seller at the same price. I never thought about it that way. So that's what keeps things from just grinding to a halt.
Precisely. It's a fascinating system when you think about it.
Definitely dynamic. Speaking of dynamic, let's talk about those terms we always hear on the news, bull and bear markets. What do they actually mean?
They always sound so scary.
Yeah.
These terms are basically used to describe overall market trends. Think of a bull market like this. It's a snowball effect. As prices start to rise, more investors jump in.
Makes sense.
And that fuels the upward trend even more. This can go on for months, even years.
Oh.
And it usually means rising prices across different types of assets, not just stocks.
So it's not just limited to the stock market.
Nope. It's like a rising tide that lifts all boats.
I get it. So if we see a booming economy, strong corporate earnings,
Yeah.
those are signs of a bull market.
Exactly. Those are some key ingredients. When people have jobs, the economy is growing, companies are making money.
Everyone's feeling good.
Exactly. Investors feel confident about the future, so they're more likely to invest, which pushes prices up even higher.
So it becomes this self-fulfilling prophecy, in a way.
To a certain extent, yes. But then we have the flip side, the bear market.
Uh-oh. Not so good.
It's that sinking feeling you get when you realize you left your phone in a cab.
Oh, no. Not the phone.
Yeah, that's the feeling.
So a bear market is when things aren't looking so rosy.
Exactly. It's a period of declining stock prices.
Like a downward spiral.
Kind of, yeah. Usually marked by a drop of 20% or more. And this can last for at least 2 months.
2 months of stock market gloom. What usually sets off this kind of market downturn?
Well, several things can contribute. Declining corporate earnings, a weak economy.
It's the opposite of those bull market ingredients.
Exactly. And sometimes it's just negative sentiment.
What do you mean?
Just investors feeling pessimistic about the future.
So fear can actually drive the market down?
It definitely plays a role. Think about what would happen if a company announced disappointing profits, or if there were rumors about layoffs. Investors might start selling off their shares, pushing the price down further.
And that could create a ripple effect.
Precisely.
Yeah.
It's the opposite of that bull market snowball.
Makes sense. So is it all doom and gloom during a bear market?
Well, it's important to remember that markets are cyclical.
You mean?
They go up, they go down. It's like the season's changing.
Okay, so bull and bear markets come and go.
Exactly.
That's actually kind of reassuring. So even when things are down, there's always a chance for a turnaround.
That's the beauty of it, and that's why it's so important to approach investing with a long-term perspective.
Even if you start during a bear market.
Especially then.
I like that mindset. Okay, this actually leads perfectly into the next part of our deep dive.
Right.
Figuring out what to consider before you actually start investing. What are the essential steps someone should take before they jump in?
Well, think of it like preparing for a marathon.
Okay, getting ready for the long haul.
You wouldn't just show up and start running without any training.
No way. So what kind of training do we need for investing?
First things first. Tackle any high-interest debt you might have.
Like credit card balances.
Exactly. Those interest rates can be brutal. It's unlikely any investment will outperform them.
So it's like clearing the hurdles before the race even starts.
Precisely. Get those out of the way. Next, you need an emergency fund.
Emergency fund. Essential.
Absolutely. Your financial safety net. Ideally, 6 to 12 months of living expenses, stashed away in a safe and easily accessible account.
Okay. That's like having a first aid kit just in case.
Exactly. You never know what life might throw your way.
That makes me feel a lot better already.
Yeah.
What other beginner-friendly tips should we keep in mind?
Let's see. Avoid lifestyle creep.
Lifestyle creep. What's that?
As your income grows, it's easy to start spending more.
Oh, yeah, I've definitely been there.
Right. But that can really sabotage your savings goals.
Makes sense. So stay disciplined.
Absolutely. Even small, consistent investments, they can really add up over time.
Slow and steady wins the race.
You got it. Think of it like building a muscle. It takes time and effort, but the results are worth it.
I like that analogy. What about those spare change apps? Are those a good way to dip your toes in?
You know, the ones that round up your purchases.
Yeah, and invest the difference.
Absolutely. Great way to start without feeling overwhelmed, like you're starting with a light jog before you go for that full marathon.
I love that. Okay, so we've tackled debt, built an emergency fund, and resisted the urge to splurge. Anything else to think about before we look at specific investments?
One more crucial thing. Your investment goals. What are you saving for? Retirement, a down payment on a home.
Travel the world.
Exactly. Your goals are going to shape your investment choices.
Right, because a long-term goal like retirement might need a different strategy than, say, saving for a vacation.
Spot on. And along with your goals, you got to consider your risk tolerance.
Risk tolerance.
How much potential loss are you comfortable with? If losing 10% of your investments would keep you up at night, you probably have a lower risk tolerance.
And someone who's investing for retirement, like decades away, might be okay with riskier investments.
Because they have more time to recover if things go south. You got it.
This is all making a lot more sense now.
Good. Now, before we dive into those different investment options, let's talk about a concept that's super important for any investor, no matter what their goals or risk tolerance: diversification.
Diversification. I hear that term all the time, but what does it actually mean in a way that makes sense?
Imagine you're at a buffet and you only put one type of food on your plate.
Okay, picking my favorite.
Even if it's your favorite, what if you get tired of it?
Good point. Or what if it upsets my stomach?
Exactly.
So diversification is basically not putting all your eggs in one basket.
You nailed it. It's about spreading your investments across different asset classes.
Like stocks, bonds, real estate.
Yep, different sectors, even different geographic regions.
Oh, wow. To reduce risk.
Exactly. So that if one investment doesn't do so well, your entire portfolio isn't completely wiped out.
It's like creating a financial safety net. I love it.
Exactly. Now, are you ready to explore all those different paths you can take?
Absolutely. I'm ready to see what's on the investment menu. Welcome back to our stock market journey. We just wrapped up talking about how important diversification is in investing.
It's all about balance.
It's like building a well-balanced meal.
Right. A little bit of this, a little bit of that. And now we're going to zoom in on one of those key ingredients: stocks.
Okay, stocks.
Before we dive in, though, there's this fundamental principle we've got to understand. Risk versus reward.
I feel like I've heard that phrase a million times, but to be honest, I'm not always sure what it actually means in the real world.
Okay. Imagine you're at an amusement park. You see a roller coaster, promises a thrilling ride, but it also comes with that risk.
Oh, for sure. Screams, maybe even a little nausea.
Right. But then there's the merry-go-round. Much calmer experience, but...
Not as much adrenaline.
Exactly. So in investing, the higher the risk you take, the higher the potential reward. That's how it works.
Okay, yeah, that's starting to make more sense. So with stocks, you're saying there's a chance to make big gains, but you could also lose money.
That's the trade-off. Think of it this way. Investors who think a company is going to do really well, they're willing to pay more for its stock.
They're betting on it.
Right, expecting its value to go up.
Right.
But if the company doesn't live up to those expectations...
The stock price could drop.
Exactly. So it's not just about picking companies you like. It's about, digging a little deeper, understanding their potential for growth.
And the risks involved.
You got it. And this brings us to a topic that's always up for debate.
Oh, what's that?
Individual stock picking. Trying to choose those specific companies that are going to beat the market.
Yeah. Like, is it actually possible to do that consistently? To just pick winners all the time? Or is it kind of like gambling?
Well, you might get lucky with a few picks, but consistently beating the market.
Tough.
Incredibly challenging, even for the pros.
Really? Even for people who do this for a living. So what makes it so difficult?
Well, first of all, it requires a ton of research, a lot of analysis. You've got to understand the company's financials, its industry, the competition, you name it.
There are so many factors.
And even then, there are no guarantees. I mean, the market, it's constantly shifting and changing.
Unexpected things can happen.
All the time. Things that could derail even the most promising companies.
Wow. Makes sense why it's so hard to predict.
Yeah.
Any wisdom from the investing legends about this?
Well, Warren Buffett,
The Oracle of Omaha.
he's famously skeptical about individual stock picking, at least for us non-professionals. He often says, just own a diversified basket of stocks.
Spread that risk.
Exactly.
So instead of trying to pick individual winners, it's better to kind of bet on the overall market.
It's a more reliable approach, especially for most people. And this actually brings us back to the importance of diversification.
Okay, yeah. We talked about diversification before in terms of those asset classes like stocks, bonds, real estate. But what about within stocks themselves? How do you diversify there?
Well, think of it like building a strong team.
Okay.
You wouldn't want a team where everyone was amazing at offense but terrible at defense.
Right, you need a mix of skills.
Yeah.
So in stocks, are you saying to spread your investments across different industries?
Exactly.
Like some tech stocks, some healthcare, some consumer goods?
That's the idea. That way, if one sector isn't doing so well, your whole portfolio isn't going to, crash and burn.
It's all about balance. I'm starting to see a theme here.
Balance is key. Now, I know there's this whole buy low, sell high thing. It sounds super simple.
Yeah, it does.
But I bet it's way harder to actually pull off.
It's got to be. It's not like we have a crystal ball to see the future.
Right. And stock prices, they just bounce around all over the place. They're influenced by all sorts of things. News, economic data, even just how people are feeling about the market.
So even if a stock seems low at this very moment, it could go even lower.
That's right. And a stock that seems high, it could keep climbing.
Oh, wow. So trying to perfectly time the market, it's a recipe for disaster.
It's like trying to catch a falling knife.
Ooh, not good. So if we can't predict what stock prices are going to do, how do we make good investment decisions?
That's where research comes in, doing your homework. You've got to analyze and think long term.
I'm all about the long game, but what does that actually look like?
Instead of chasing those quick wins, focus on building a diversified portfolio with companies you actually believe in. Hold those investments for the long haul.
So it's about more than just chasing quick profits.
It's about building something that can last. It's like planting a garden.
Okay.
You don't expect to harvest your tomatoes the day after you plant the seeds, right?
Right. It takes time, patience.
Exactly. So even if the market dips in the short term, if you've chosen solid companies, those investments should grow over time.
So ride out those waves and keep your eyes on the horizon.
That's the idea. There's a saying, time in the market beats timing the market.
I like that.
Now, besides having that long-term perspective, there are other key strategies that can help you succeed as an investor. But we'll dive into those when we come back for the final part of our deep dive.
And we're back for the final stretch of our stock market deep dive. I'm excited to hear about those other strategies you mentioned, those secret weapons for investing success.
All right, let's unlock the vault. One technique that often gets overlooked, especially by new investors,
Yeah.
it's called dollar cost averaging.
Dollar cost averaging, that's a new one for me. What's the basic idea?
It's a simple but powerful strategy.
Okay.
It's all about investing a fixed amount of money,
Okay.
but at regular intervals.
Right.
And you do this regardless of what the market's doing.
So instead of trying to time the market, like we talked about earlier.
Right, exactly. Instead of trying to guess the best time to buy in and invest a big chunk of money all at once,
Yeah.
you're consistently investing, say, $100 every week,
Just steady, consistent
no
investments.
matter what those stock prices are doing.
Okay. Okay, so it's like setting up automatic payments for my investments.
Exactly. It takes the emotion out of it.
That's good, because I can get emotional.
We all can. This way, you're less likely to make that classic mistake of buying high and selling low.
I see. So if the market happens to dip during one of my investment periods, I'm actually snagging more shares at a lower price.
You got it.
Kind of like a sale on stocks.
Exactly. And over time, this can really help to average out your purchase price.
Okay.
And it could potentially boost your returns. It's a fantastic strategy for long-term investors.
Especially for beginners.
Absolutely.
I like it. Now, earlier you mentioned different types of orders
Yeah,
that you can place when you're buying or selling stocks. What did you mean by that?
right. It's important to know what tools you have at your disposal. It's
Mhm.
like choosing the right kitchen utensil for a recipe.
Okay, love the analogy.
So a market order, that's like your chef's knife. It's quick, efficient, but you need a bit of skill and precision.
So a market order gets the job done fast, but what's the catch?
Well, with a market order, it's executed right away at the best price available at that exact moment. But because those stock prices are always fluctuating,
Right.
the price you end up paying might not be what you expected.
Especially if the market's moving quickly.
Especially then, you could end up paying more than you planned.
Oh no, so is there a way to avoid that?
That's where a limit order comes in. Think of it like a measuring spoon.
Okay.
It gives you that control over exactly how much you're buying or selling.
So with a limit order, I can set the exact price I'm willing to buy or sell at.
Exactly. Let's say you want to buy some Apple stock, but only if it drops to, say, $150 a share. You can place a limit order at $150.
Okay.
And your order will only go through if the stock actually hits that price.
I like that. More control.
Yeah.
Any other order types I should know about?
There are many, but a useful one for managing risk, that's a stop-loss order.
Stop loss. What's that one do?
It's like a safety net. A stop-loss order automatically sells your stock if the price drops to a certain level, one that you set beforehand.
So if I set a stop loss order for my Apple stock
Yeah.
at, let's say, $140,
Yeah.
and the price goes down to that, my shares are sold automatically.
That's right. It helps to limit your potential losses.
Okay, so it's like a safety mechanism.
Exactly. Very valuable, especially when the market's going up and down like crazy.
For sure. This is all so fascinating, but also a little overwhelming. Investing really is like this whole other world.
It can be a little intimidating, but with what we've learned today, you're on the right track.
It feels like I've got a map to navigate this whole stock market maze now.
You're definitely better equipped, but remember, investing, it's a journey.
Right. Not a destination.
Exactly. The market's always changing, so it's important to stay informed, keep learning.
So we never really stop learning.
Nope. You gotta adapt your strategies as you go. Just like those companies we invest in. They're always evolving too.
Makes sense. Any final words of wisdom for our listeners as they set off on their investing adventures?
Absolutely. Always remember, investing, it's a long game. Don't let those short-term market swings freak you out. Don't fall for the latest fads.
Stay focused.
Exactly. Stick to your plan, stay disciplined, and build that diversified portfolio that aligns with your goals.
Love it. It's all about having that clear vision and staying the course.
You got it. Now, before we wrap up, is there a final question we can leave our listeners with? Something to really make them think.
Ooh, I like it.
All right, how about this? What kind of investor do you see yourself becoming? Someone who actively picks individual stocks? Or maybe someone who takes a more hands-off approach with things like ETFs and index funds? Or a mix of both?
That's a great question. And it really highlights what's so cool about investing. There's no one-size-fits-all approach.
Right.
It's about taking charge of your financial future, making smart choices, and creating a portfolio that reflects you and your goals.
Well said. With everything you've learned today, you're ready to take those next steps.
Towards a brighter financial future. And that concludes our deep dive into the stock market. We hope you've enjoyed the ride.
We hope you feel ready to explore the world of investing.
With confidence and curiosity. Until next time, happy investing.